Hey guys, Justice Roberts here with Paramount Residential Mortgage Group. Today I'm going to be talking about rate buydowns explained fully. So you may or may not have heard of temporary rate buydowns, and it's been, in my community, in the lending community, it seems like it's been pretty saturated, but I've still been having conversations with individuals, clients that I've had that have heard things about them that it doesn't seem like it's fully clear, like all the details are coming through, and as well as understanding why, where it's like, it's great that we're dropping the rate, but why does that actually make sense? And, the more I'm getting into conversation, I thought it'd be helpful to maybe share more of a holistic understanding of, number one, why a rate buy down, but then also the nuts and bolts of exactly how it works in a few different scenarios. So hopefully this is helpful to you. I'm going to dive right in. So, problem, opportunity, strategy. So problem, here's what we're experiencing in the market. Interest rates have increased, home prices have remained stable, or maybe they've increased in certain markets, making affordability a huge concern and just a reality for so many families. This is just what's real. This is what the problem is. Opportunity. For every problem, there's an opportunity. There's opportunity for home buyers in this market that can capitalize. There's much less competition for homes, resulting in more safe offers and an easier point of entry. So it's easier for you to get into a house. If you think about 2020, 2021, first-time home buyers getting into a house, if you weren't already in the market, tough to get in because sellers were not accepting low down payment offers, paying closing costs, all that sort of stuff. So there's opportunity here in this market. Now, strategy. The strategy is to make purchasing a home notably more affordable in our current interest rate environment so that you can buy a home that makes sense right now. Now, obviously, we're going to dive into this, and whether or not it makes sense is going to be completely up to you. But I'm going to still arm you with some knowledge and some information. So who is this for? Who is this not for? This is for first-time home buyers. This is also for move-up home buyers. So if you are selling a current home or moving from one home to the next home, but you're purchasing a primary residence, also works for vacation home purchases, anything with a traditional loan. So if you have a conventional loan, FHA loan, VA, or USDA loan, this is all applicable. Who this is not for? Investors. Jumbo loans, non-QM, non-traditional loans, refinance loans, second mortgages, HELOC, HELoans, and refinance loans to boot. I added that again just to hammer this in. So even if you are financing a primary residence, this would not apply to any refinance, rate and term, cash out, or any of the like. This would be for purchase scenario only. Our philosophy is what drives our advice. I want you to holistically understand why I think this is a good idea for some home buyers. And once you understand the what, maybe you're going to be able to identify whether or not this makes sense for you. But I want to give you some context for why I feel like, based off of how the market is currently trending, why this could be a great opportunity, not only for you to buy a house, but to buy a house using this strategy, because I think that you as the home buyer come out and you win in this specific market. I want to talk to you about the Fed. This is part of understanding the market, is understanding what role that our Fed plays and how that impacts the market. And here's what I'll say: success leaves clues, but they must be acted upon. It's a quote by Tony Robbins. So I'm going to give you some history on some Fed chairs. So Burns and Volcker, inflation from 7 to 14%. So they went through a time similar to what we're going through in our market right now. Our inflation with Jerome Powell, if you go down here, was 1.5 to 9%. They went from 7 to 14%. So pretty drastic. Mortgage rates in their scenario went from 12 to 18%, makes our top peak at 8% not seem so crazy. Their Fed funds rate went from 11% to 20%. Inflation responded by moving from 18% to 12%, and their mortgage rates responded by moving from 18% to 12%. Kind of interesting how those were correlated. Greenspan, this is Alan Greenspan, another scenario where they had inflation that was 1.75% and moved to 3.5%. Mortgage rates at the time were at 7. They moved all the way up to 8.5, so about 1.5% increase. The Fed's funds rate, they increased from 4.75 to 6.5%. Inflation responded from 3.5% to 1%. And then mortgage rates responded by moving from 8.5% to 5.5%. So you might see a trend here. Going through the last one is that when inflation goes up, so do mortgage interest rates. Then the Fed comes in and they do their Fed funds rate increase, and inflation drops. And then what follows is mortgage interest rates. So what we can see here is inflation rises, mortgage interest rates increase, Fed increases the Fed funds rate, inflation drop, mortgage rates follow, and also the consequences. We don't know yet currently if we are currently in a recession or if we will be in a recession, but we can say in other times where we've seen similar things, that's what's happened. But recessions are always tracked in the arrears. So they're going to look back at whatever time period and going to go, yes, we were in a recession then. They have made some determinations in the past where you get a certain amount of quarters, typically two negative quarters of GDP, we'll call it a recession, but our current Fed is not acknowledging that as the definition of a recession. So mortgage rates have come down in the last 6 recessions. So I think it's important to note, and I would say without saying that we may or may not be in a recession, but what we've seen, even if we're talking about going into a recession, which I feel like is likely at some point if we're not already in it, is that interest rates will come down as proven by the data. Interest rates 16% to 11.75, 18% to 13%. These are all measuring inflation and then what we saw happen from interest rates in these specific time periods. 11 to 8.75, 7.375 to 6.75, 6% to 4.875, and 3.75 to 2.75. So we've seen over time, every time we run into a recession, interest rates drop. Now, housing prices have also gone up in 5 of the last 6 recessions. I think it's really important to understand that when we look at a recession and we're going, okay, it's great that interest rates are going to come down, but what then are we considering with home prices? Because that's a real concern. That's a real, that's something really important to make sure that you're thinking through and understanding. Well, it's like, okay, great that we've gone into a recession. That means that rates are low, but what if my property value dips? What if my property value isn't where it needs to be, which could impact several things? Number one, your investment and thinking about making a good, wise financial decision, which I think if you look at real estate over time, maybe you'd be okay with that. But practically, we talk about our strategy with a rate buy down. If you're getting into a house and then the value of that drops, it would make it challenging to be able to refinance if your home dropped in value. So I think it's a great question to be asking yourself is, what will happen to home prices if we're talking about a recession? So I'll give you some history on that. So we have here in 5 of the last 6 recessions, home prices have gone up. Now, that's not saying that that's what's going to happen this time, because we saw in 2007, 2008, home prices actually declined in a recession. Now, here's the thing about 2007, 2008. The cause for the recession was the housing market. Let me say that again. The cause for the recession was the housing market. So it made sense that home prices would come down when the reason for the recession was because of subprime mortgages and loans that shouldn't have been done, and a market that was set up for failure. And that was specifically in the real estate market. And so home prices going down in that market makes a whole lot of sense given what happened. However, in other markets, we have seen that home prices have appreciated in 5 of the last 6. Very important. Okay, what happens to housing in recession? Just a little bit more detail here, just to kind of like solidify what we're talking about. Number 1, interest rates typically go down. Number 2, housing becomes more affordable. That's partially because interest rates have come down. Number 3, more buyers enter the market. And if you think about what the Fed is doing when they are increasing the Fed funds rate to drop inflation, then they push us into a recession because they're going, hey, we don't want people to be buying and spending all this money. And then what happens as we go into a recession, interest rates come down because the Fed is trying to then stimulate more activity, more buyers enter the market, and then more demand increases than we have the supply, and prices stabilize at worst, and at best they accelerate. So think about this from a question. If I was to ask you what would happen if in the market interest rates went to 5% today, if the market interest rate went from where it's at right now to 5%, what would happen? And the answer, I've asked this to multiple people, multiple real estate agents, multiple clients, and the answer is, like, it would be gangbusters. It'd be crazy how fast people would be, going in, jumping into the housing market again. How can you position yourself as someone who doesn't have to work with all of that competition to be able to actually get into a home and not have to be fighting so many other buyers, and then also having to pay a premium for that asset? Let's keep going. A solution: temporary rate buy down. This is a solution. So here's what a temporary rate buy down is. It's the seller paying the difference of the market rate versus the buy down rate. So another way to say it is, it's your payment plus the seller payment equals the total payment. So let's just say the total payment was $3,000 and the seller is going to pay $700 of that $3,000. That's going to leave you with paying $2,300. Let's review your options. So there's 3 different options as far as interest rate temporary rate buy downs. You have a 3-2-1 buy down, a 2-1 buy down. Let's call it a 1-1 buy down, or a 1 buy down, 1 year buy down. How it works is basically, if you do a 3-year buy down, your first year is going to be 3% lower than the market rate. Your second year is going to be 2% lower than the market rate. Your third year, it's going to be 1% lower than the market rate. And then every year after that, for the fourth, moving forward, it will be at the market rate. So, and then you have the 2-1 and then the 1-1 buy downs, which are all other versions of it. But for instance, with a 2-1 buy down, which is most common, your first year is not 3% lower because we're doing a 2-year buy down. So it's only 2% lower. And then the second year is going to be 1% lower. 3 years and more, it's going to be at the market rate. Let me give you some ideas. So let's give you a scenario at a $500,000 loan. Again, this is not a $500,000 purchase price. I'm assuming a market rate of 7% and using a 3-2-1 buy down. So the principal and interest payment is $33.26. So let me show you what you pay. Year 1, you're going to pay 3% less. So instead of $33.26, you're going to pay $23.87. Year 2, you're going to pay 2% less, which is $26.84. Year 3, 1% less is $29.97. In year 4, you're going to pay $33.26. So thinking about it from your perspective, there's a few things that stand out to me. Number one, it's great that we're having a low starting interest rate, but that is a stair-stepping rate. It's important to understand that when lenders are qualifying you for this loan, you are having to qualify based off of the fully indexed rate, or basically the complete payment of $33.26. So you have to be able to qualify for that total payment based off of your income and everything else. Now, I've seen a lot of people in the industry that have talked about these temporary rate buy downs as like, hey, you're only going to have to pay $2,300, $2,400 for your mortgage payment, when in actuality, it's a lot more than that. And I definitely, where I think this is a great strategy, I would never want to use it as any form of manipulation to make you think that getting into this house is actually you making that $2,400 payment and then surprise, your mortgage payment goes up, because I think that would be a disservice to you. That would be disingenuous, and that would not be I wouldn't be able to live with myself. But I do think that holistically, as I'm having conversations, looking at that year 4 payment, or that, what's the total payment, and it may be a push, but if you go, hey, and if push came to shove, I could make that payment. And if we had to do it, I don't want to make that payment, but if I had to make that payment, we could still live. I could still survive. And we're thinking about the fact that year 1, year 2, year 3, think about things realistically. Like, yes, I'm realistically talking about you needing to make a bigger payment, but realistically, also think about the market and where things are at with your job. Do you think over the course of the next 3 years that there would be any form of increase in your current income that may be able to offset or put you in a better position to where making this higher payment would actually be less of an issue 3-4 years from now, or 1-2 years from now? There are always adjustments that typically happen over time. With inflation, we're seeing that pressure wages up. And so I think that it's important to understand, yes, you're going to be required or want to plan for worst case scenario, which is you're in this loan for the long haul. But it's also important to understand, okay, what are also the other possibilities of likely what would end up happening over the course of the next 3 years? So here's what you pay. That's important to understand. Now, next thing is what the seller pays. So how this works with the seller is we're going to negotiate a seller contribution to cover the full amount for year 1, year 2, and year 3 in this specific scenario. And here's what it kind of looks like. Year 1, the seller is going to contribute $939 per month for 12 months, which is totaling $11,268. So the difference between $2,387 and $3,326 is $939. And that's what they're going to pay for the full first year. Year number 2 is $7,704 because it's only $642 per month difference between the $2,684 and the $3,326. Guys, this is simple math. If you add it up on a calculator, it adds up total, as long as I did my math right, and I know I did. Year 3, $329 per month, which is $3,948, which means the total seller subsidy is $22,920. So if we were to negotiate a seller subsidy or a seller credit, seller incentive to go towards a rate buy down for you, this is how it would be applied. Now, it's also important to understand how your reserve account works. So at closing, the seller pays into the account in full. So they're not going to write a check every month for $939 and whatever. It gets put into a escrow account, a reserve account, similar to like what your property taxes, your home insurance is. And it's basically gets drawn on month over month. So at the beginning of the balance, it starts out at $22,920. And at the end of year 1, your balance is going to be $11,652 because you've pulled $11,268 out of that. End of year 3, holy cow, my numbers are not adding up here, but pretty much you have about $7,000 or you have about $4,000 left after the end of year 2. And then end of year 3, you're going to have $0 that are left. So here's a quick note. If you refinance or you sell the house at any point prior, you get to keep the subsidy. This is a huge part of understanding why this is a great idea. Because if we negotiate all the funds from the seller and then it goes into this separate account and then you refinance down the road and you lose that money, you lost all the benefit. This is your money, because in that scenario, typically a negotiation perspective, I would recommend to negotiate off the purchase price. However, if you negotiate it instead in the form of a seller credit to apply to a rate buy down, this is money that you will always get the full benefit of. You will never lose a single dollar of it. You will either be applied completely to your monthly payment subsidy, or it will be applied to a direct principal reduction on your loan, which is also the same as dollar for dollar what your purchase price is. So instead of requesting $22,000 from a seller in price reduction, if we negotiated $22,920 to go towards a rate buy down, then every dollar you're going to get the benefit of it. It's either are you going to get the benefit on the front part of the loan with your monthly payment, or are you going to get it on the purchase price, which is your loan amount. Or in a case where you end up refinancing, that will drop on the purchase price, and it's just as good as the price reduction in and of itself because you get all the money set aside for you there. Now, I'm going to give you a real life example. So, had a family. We are days away from closing. Their loan's already fully approved. Family with 3 kids. They needed more space for their family. And they notably increased their income over the last 7 years. This is a move-up buyer. They found their dream home, and is about $805,000. Not about $805,000. It was $805,000. We negotiated $24,000 to go towards doing a 2-1 buy down and other closing costs. So the total buy down amount, moving here through the numbers, was $14,676. The rest of the $24,000, we actually applied it to their closing costs. So majority, they paid just the down payment, and we rolled in. We didn't roll in. We got the seller to pay for closing costs and their rate buy down in completion. They're saving about $810 per month for the first year and $413 per month on the second year. And they're moved in. Life goes on. They aren't worried about their payment. We're going to proactively monitor their mortgage and manage it for when an opportunity is right for a refinance. Summary. Here's why I really like this strategy in this market. It's the most impactful way to move the needle on your monthly payment. Out of any strategy that's out there, this is the strategy that's going to make the biggest amount of dent on your monthly payment, which affordability being the biggest concern for many families. This is why I like this strategy. Number 2, you never lose the money that you negotiate from the seller. If we're going to negotiate this, and we apply it towards closing costs or a permanent rate buy down, it's not as beneficial because you may or may not get the full benefit of those dollars that you're negotiating. Number 3, you can refinance into a long-term loan anytime. Markets are cyclical, okay? It's not if interest rates will come down, it's when they're going to come down. And I can't tell you when they will, but I can tell you that they will. Number 4, you can take advantage of all the benefits of negotiation now. Everything from the closing timelines, obviously the seller incentives, inspection contingencies, appraisal contingencies. You can purchase a home in a way that protects you and your family rather than having to waive all your contingencies like we've seen the last few years. And you ultimately are hoping that nothing bad happens. You get to purchase a house, your biggest investment, in a way that actually makes sense. And then number 5, home appreciation upside when demand increases. I think this is huge. If you purchase a house in a market right now where home prices are maybe trending up a little bit, but a little bit more on the flat side, when interest rates go down, you will have the asset, be able to refinance. And as other buyers are jumping into the market where demand is outpacing supply, you will be the benefactor of that, not having to compete in a market, but rather getting the benefit of the market that's going to raise your home value. And you didn't have to do anything other than insert yourself at the right time and ultimately position yourself to make the mortgage payment in this current market, but not having to make that payment for forever. So, guys, I hope you enjoyed this. Hope this was helpful. Let me know if you guys want to learn more. My contact information is below. Be great. You were amazing. Talk to you soon.